I work for Europa Capital, and I think one of the keys to investing in distressed real estate is you need to catch an institutional exit at some stage. And I think the comments are fair that maybe the investment conduits into distressed real estate are by and large North American, or if European, primarily backed by North American investors. But what North America has not yet really brought to Europe is the institutional takeout capital, and there we're very, very reliant still on a domestic institutional investor base. And I think at the moment that remains incredibly cautious of the economic outlook over the next 2 to 3 years in Europe. And I think the opportunity that the weight of capital is looking to grasp at the moment is perhaps going to see some of its exit strategies frustrated in the short term, perhaps not in the medium to longer term, but this is all time-weighted capital that cannot wait indefinitely.
Okay. I'd agree. I think there's tons of capital for London, and there's tons of takeout capital for German residential. But those two aside, I think where you're operating elsewhere in Europe, in whatever sector, geography, or asset class, there's not a lot of visibility about that takeout. I agree. And the German, historically it was the German open-ended and closed-ended funds. They've got their own issues at the moment. Some of them are back raising capital and deploying capital, but some of the French institutions are beginning to look, interestingly, outside France. This deal La Française put, there's 25% into Forum yesterday and gave them 600 million of capital to seed vehicles, although Forum's global. But there's a few things, but I agree. I think it's still pretty difficult outside of those two areas to really get visibility on takeout.
I agree with that. Although I think we find German insurance company investing increasingly on an cross-border basis, and to the extent to which they will be increasing their allocation to real estate, which a lot of them seem to do, albeit they're putting real estate in a sort of real assets bucket, but potentially going up to 25%. There is more and more money going into real estate. And one thing we've seen very recently, but it's probably slightly more on the capital markets level, but up to now, obviously the US interest in Europe has been purely in distressed plays. But if you look at, there's a lot of US funds now taking positions on some of the equity raisings of the REITs and on the sort of convertible loan stocks. So they're beginning to take a more relaxed view of Europe as well. So there is a sort of flow of capital as well.
I mean, I think, people in the room know it well that the US investors have always wanted this perceived premium for investing outside the US, which was tax, currency, transparency, you name it. And I think, TIA-CREF were an early adopter and changed that perception so that an office building in Munich could probably yield the same as an office building in Boston, and they got the fact that probably worked, or maybe it was less than Boston, probably is. CalPERS are beginning to get that mindset. So we might find over time more US institutional pension funds and insurance companies buying assets in Europe at the prices that they should be paying, rather than at rates where they're asking for all this risk premium.